Hi, welcome to this quick video. We're going to talk about passive and active funds management. Specifically, what's the difference between the two? So what's coming up in this video? This video will include the key difference between passive and active management, and then we'll talk about issues, benefits and drawbacks of active funds and then of passive funds. And then we'll just do a quick review. So the key difference between passive and active funds management. Active funds actively try to beat a benchmark performance, such as an index, by picking individual groups of stocks that will outperform the market. So for instance, if you invest in an active fund and the active fund's goal is to do better than the S&P 500, then they will pick individual stocks from the market in the aim of beating the S&P 500. On the other hand, there are passive funds. And passive funds attempt to mirror the performance of an index by holding groups of stocks that reflect the underlying index as per its constituents and their relative proportion within the index. So if we talk about the S&P 500 again, a passive fund would try to match the same returns of the S&P 500 by holding 500 stocks, all of the stocks in the S&P 500. So it would effectively be a mirror of that same index. So let's go into specifics of active management. There are a few key issues. They have a heavy reliance on research, security analysis, and professional investment managers. They try to identify securities that are not priced correctly relative to their intrinsic value. So the investment managers invest heavily in research and security analysis, and from there they try to pick the stocks that are overvalued and undervalued and buy or short those stocks. And as a result, active management generally have a higher portfolio turnover, and that just means more transactions occur as stocks are bought and sold more often. So what are the benefits of active management? Well, if the fund manager performs well and their fund investment strategy is successful, you can have superior returns. You can beat the market, such as the S&P 500 or the Dow Jones or the FTSE. If the S&P 500 performs at 15%, you may get a return of 20 or 25 or 30%. Secondly, you're not weighed down by all the lousy stocks within an index. If a passive fund that's trying to mirror the S&P 500 has to buy all 500 stocks, they consider all the really lousy stocks in the S&P 500. Now I imagine holding Enron or Lehman Brothers prior to their collapses wouldn't have been the best stocks to buy, but they would have been held within those index funds before obviously they collapsed and left the index. And the third benefit is more of a benefit to society, because active funds contribute to the efficiency and liquidity of public markets. They contribute to the efficiency of the market because these analysts within the active funds are specifically trying to find out information about particular stocks, whether they're overvalued or undervalued, and they disseminate this information into the public markets. They buy and sell stocks, which actively pushes the price of the stocks towards their intrinsic value. They also add liquidity because they trade a lot more often than your standard passive managers. Your passive managers will generally buy a stock within the index and hold it for as long as it's in the index, so that it doesn't contribute to liquidity, while an active manager's purchasing and sales do. So how about some of the drawbacks of active management? Well, the management fees for these funds are higher. So if you invest in these funds, you will pay higher management fees. This is because of the extra experienced staff, the research costs, such as data providers and all of the other services that go into research, the transaction costs because you're buying and selling stocks more often, and also the tax implications that occur when you sell stocks more frequently at a higher price than you paid for them. A second drawback is that there is quite a bit of academic research that claims active managers on average don't beat the market, which really isn't that great. You invest in active funds to beat the market, but there is a lot of history that only a few managers outperform the market. And even then, it's very hard to consistently outperform the market. Thirdly, and this is in more a general sense, there are lower levels of diversification in active portfolios. So while most funds do have a wide variety of stocks and do have a lot of diversification, a portfolio of 20 or 30 stocks within an active fund would still have far less diversification than, say, 500 stocks of the S&P 500. Now let's move on to passive management. Here are some key issues. They are price takers in the market that rely more on administration tasks relative to security analysis. In other words, if a fund is in the index, whatever the price is for that particular stock, they buy it. They don't assume that it's a good price or a bad price or a high price or a low price. They just take the price whatever's on offer to match the market. This is more of an administrative task, and they don't involve themselves in too much security analysis about good stocks or bad stocks to buy. They accept that the overall index performance is quite satisfactory, specifically when combined with the lower management costs involved in managing these funds. And thirdly, there has been an increasing adoption of passive funds over the past 2 decades. These funds have become very popular with investors, and there's an increasingly availability of different types of funds available to investors. I've specifically been talking about the S&P 500, but you'll find a huge variety of type of sectors or indexes or countries or a whole mix and match of different passive funds that you can invest in. So what about the benefits of passive funds? There are lower costs for investors, and this is kind of just the reverse of active funds. There are lower staff expenses, lower research costs, fewer transaction costs because there are fewer transactions, and fewer taxes paid by the funds because there are fewer transactions overall. On the flip side also, there is evidence that passive funds, on average, outperform active funds. Now there's a great debate between passive funds and active funds and which one is better, but most of the research and evidence states that passive funds outperform. And obviously, if you're owning every stock in the index or every stock in a sector, there is an increased level of diversification. And secondly, there's increased simplicity for investors. Active funds can sometimes be a bit opaque. You invest in a manager or you invest in a fund and you don't really know what's going on underneath. With passive funds, if you're investing in a Dow Jones passive fund or a FTSE 100 passive fund, then you know exactly what's going on. You know what stocks they're buying. You can watch Bloomberg or CNBC and see what the index is doing and measure the performance on a daily basis. It's a lot simpler for investors to understand. What about the drawbacks? Well, the investor returns will always be below the market index due to management fees, even though these management fees are small. So you invest in a passive fund to match the market returns. But if you're holding an exact portfolio of an index, plus you have to pay management fees, there will always be a slight subpar performance of these passive funds. There'll always be the market return minus the management fees. Secondly, the funds very often don't exactly match the index being mirrored. Because very often investors can sell their units in a particular fund or new investors can buy additional units, these smaller contributions in the overall fund make it very hard to keep track of exactly a mirror image of the market. So these funds are an approximation rather than being an exact reflection of the market index. And the third drawback is that being a constituent of an index is the only condition that a stock is worth buying. Now, if we look at ourselves as investors and consider what we want to invest in and what we want to hand over our hard-earned money in, we don't just look at an index and pick a rabbit out of a hat. We want to know we're buying good stocks and not just picking a number out of a hat, which is effectively what you're doing when you buy a passive fund. You're picking every single stock within the index or every single stock in the sector. Is this a good idea that this is your only condition that a stock is worth buying and handing over your hard-earned money? Okay, well that's about it. Let's just review what we covered. Passive and active funds management. Active funds are actively trying to beat the market. Passive funds are passively trying to mirror the market. Active funds rely more on security analysis, and passive funds rely more on administration. And finally, active funds have higher costs with the opportunity for higher returns, while passive funds have lower costs and accept market returns. That's it. Thanks for your time. That is a very quick guide to the differences between passive and active funds management. I hope you can give me a thumbs up. Cheers. Thanks very much.